When you use an online brokerage to buy and sell securities, you need to be aware of the potential tax implications. This presentation is presented by student attorneys with the Low Income Tax Clinic at South Texas College of Law, Houston. We provide free legal representation to low-income taxpayers in the Houston metropolitan area. We work with taxpayers that have IRS audits, appeals, tax collection matters, and other tax disputes. If you have an IRS issue, feel free to give us a call at 1-800-646-1253 or email us at taxclinic@stcl.edu. This video is not intended as legal advice. Here are some of the key tax considerations you should keep in mind when using an online brokerage account. A brokerage account is an investment account used to trade assets such as stocks, bonds, mutual funds, and exchange-traded funds, also known as ETFs. Brokerage firms range from pricey, full-service stockbrokers to low-fee online discount brokers. Full-service brokerage accounts include Merrill and Morgan Stanley. Discount brokerage accounts include Charles Schwab and Vanguard. Finally, online brokerage accounts include Robinhood and Acorns. You should keep in mind that crypto exchanges work similar to online brokerages. When it comes to taxable brokerage accounts, there are some important things to keep in mind. Any income from these accounts is taxed when the income is earned. This includes things like dividends, gains, and interest. If you sell a stock at a gain, that gain is taxable. Additionally, any interest earned is taxable in the year in which it was received. Finally, it's important to keep in mind that what matters for taxable brokerage accounts is when the money is earned, not when it's withdrawn and enjoyed.
Gains and losses. If you sell an investment and make money on that sale, then the profit you make on the sale of that investment will be taxable. However, if you sell that investment and incur a loss, then that loss may be tax deductible. Calculating gains and losses. You will need to know your cost basis and the selling price of the investment in order to calculate your amount of gains and losses. Your cost basis is simply how much you paid for the investment. For example, if you paid $50 for a stock, your cost basis in that stock is $50. Remember, it's important that you keep your own records of your transaction and cost basis. If you buy a share of Tesla stock for $1,000 and you sell that stock for $1,200, you realize a gain of $200. Remember, the $200 you make on the sale is taxable. Conversely, if you buy a share of Tesla stock for $1,000 and you sell for $800, you realize a loss of $200. The $200 loss may be tax deductible. Reporting gains and losses on your tax return. You must report all gains and losses on Schedule D of your tax return. If your losses exceed your gains, you may be able to deduct up to $3,000 from your income in the current year. Your brokerage firm will provide you with a Form 1099, which will provide you with information concerning gains and losses for the year.
Wash sales. If you sell any stock at a loss and then repurchase that same stock within 30 days, you will trigger what's called a wash sale. Investors have used this as a way to claim a loss for tax purposes while maintaining a position in the stock. For example, imagine that you own 100 shares of a company called Widgets Incorporated, which you bought for $50 per share, making your total investment worth $5,000. Over time, the stock price drops to $40 per share, so now your investment is worth only $4,000. You decide to sell your shares to claim a loss of $1,000, hoping to use that loss to offset other gains on your taxes. However, just a few days later, you notice that Widgets Incorporated's stock price starts to rebound, and you believe that the company will continue to do well. So within 30 days of selling your shares, you buy back 100 shares of Widgets Incorporated at $42 per share, spending $4,200. This is an example of a wash sale, because you repurchase substantially identical shares within the 30-day window before or after selling them at a loss. You cannot claim the $1,000 capital loss for tax purposes. Instead, the $1,000 loss is added to the $4,200 cost basis of your new shares, making the cost basis $5,200. This will affect the calculation of gains or losses when you eventually sell the shares again. The IRS has established wash sale rules to prevent this by disallowing tax deductions for wash sales. So it's very important that you avoid this type of transaction when you make stock trades. Your brokerage should provide you with a record of any wash sales that occurred during the year. You'll need to report the wash sales on Schedule D of your tax return.
Dividends. Dividends are payments made to shareholders by a company from its earnings or profits, usually in the form of cash or additional shares of stock. It's essential to be aware of the tax implications of these dividends to manage your investments effectively. There are two primary types of dividends, qualified and non-qualified dividends. The distinction between these two types is critical as they are taxed at different rates. Qualified dividends are dividends paid by U.S. corporations and certain qualified foreign corporations, which must meet specific holding period requirements. These dividends are subject to more favorable tax rates, typically 0%, 15%, or 20%, depending on your taxable income and filing status. Non-qualified dividends are dividends that do not meet the criteria for qualified dividends and are taxed as ordinary income at your regular tax rate, which may be as high as 37%. When you receive dividends from your online brokerage account, you are responsible for reporting them on your annual tax return. Here are some key points to remember. You will need a Form 1099 DIV. Your brokerage account will provide you with a form which summarizes your dividend income for the year. This form will report the amount of qualified and non-qualified dividends, as well as any foreign taxes paid on those dividends.
Retirement accounts. Many brokerage accounts offer retirement accounts such as IRAs and 401ks. However, these accounts are different from regular brokerage accounts. With these, you don't pay taxes on your investments until you take the money out. But be careful, if you withdraw the money before you're 59 and a half, you might face tax penalties.
Cryptocurrency. A brokerage account can provide a convenient way to sell cryptocurrency. Many online brokerages now allow users to buy and sell cryptocurrencies alongside other investments like stocks and mutual funds. When you sell cryptocurrency through a brokerage account, you may be subject to transaction fees and potentially capital gain taxes. Cryptocurrencies are treated as property for tax purposes, which means that any gains or losses you make on cryptocurrency transactions are subject to capital gains tax. Robinhood, Acorn, and other online brokerage accounts allow you to buy Bitcoin, Ethereum, and other cryptocurrencies.
So in conclusion, while online brokerages can offer many benefits to investors, it's important to be aware of the potential tax consequences and plan accordingly. It may be wise to consult with a tax professional or financial advisor to help you navigate the complexities of investing and taxes.